Welcome to Wall Street Reporter's Company Spotlight. Today, I am speaking with Brent Suen. He is the CEO of Weyland Tech Inc. Stock symbol is WEYL. He is our next Superstock live stream presenter next week. And today this is our first interview with Brent, and we're gonna get to know the Weyland story to give everybody a bit of a sneak preview. Brent, welcome.
Thanks, Jack. Pleasure to be here.
Right, absolutely. So just so you know, our last three presenters at the next Superstock live stream, you're going to be presenting on Wednesday. Our last three companies are up between 1,300% and 2,000%. So, the audience has high expectations of you.
Understood. Well, it sounds like we're in good company and certainly enviable company. So
Brent, tell us a little bit about Weyland. What is the business that you're in?
Sure. Okay. The sort of broad stroke of who we are and what we do could be encapsulated in the Shopify of mobile. We have a specific geographic focus by way of our founder and how we started out in 2014. In Southeast Asia. There's a lot of excitement there, primarily because as a region, if you add up the population groups from the various countries that make up what's called ASEAN, you've got about 600 million people, making it a very, very viable market. Indonesia, with a specific focus, is the fourth most populous country in the world. Between Indonesia and then certainly their neighboring countries throughout Southeast Asia, what you'll see that is tremendously exciting is about 90% plus smartphone uptake, which is extraordinarily interesting because here in the U.S. we've got, we started with desktop computers, then they've
leapfrogged us. I mean, they've completely leapfrogged. That's the big thing.
Yeah, that's the best description. So they've gone from literally nothing to smartphones with the same capabilities as our iPhones and Samsungs, et cetera. So it's extraordinarily exciting there. Some of the challenges that exist there have actually enabled opportunity. So quite contrasting to developed countries such as the US or Canada or EU, is that although they've got 90% smartphone penetration in Southeast Asia, roughly about 50 to as high as 80% of populations in specific countries are what are called unbanked, meaning they don't have bank accounts and they don't have credit cards. What that's given rise to are what are called e-wallets. So that's a bit similar to, say, Apple Pay, Square, Venmo, but localized. So you'll find a number of them in the region and a number of them in each individual country. And if you look around Indonesia, for example, you'll see that there's roughly about 15, 16 unicorn valued companies that run the gamut. They're predominantly fintech. They all have an app type of product, but underlying all of them is an e-wallet. So this is critical to a company that operates in Indonesia and also within the region of Southeast Asia. You see it in other regions, certainly Middle East, Africa, Eastern Europe a bit, but it's migrating up the curve steeply in terms of tech, but they've still lagged behind the developed world in terms of ability to pay for things. We do have an element of that in our business and have for the past 2.5 years. Certainly that's a greater conversation at a later time.
Okay. Now, you're doing roughly 40 million in revenues right now, which is up. I think you were doing 12 million 3 years ago, roughly, right?
Okay. So Weyland Tech evolved from an acquisition of CreateApp, which is the brand name of our core product. The first year that we owned CreateApp, you saw revenues of roughly 12 million. That was in 2016. I'm sorry, that was 15 million in 2016. And we've grown to 34.5 million last year, which was 100% Create app. What you're seeing this year in Q1 that we've reported and that we've given guidance for going forward, you're seeing a contribution of roughly 30% this year from a recent acquisition of a group in Minneapolis named Logic, which is actually in the ad tech big data sector. So I guess going back to your question, last year was 100% Create app. This year will be about 60 to 66% Create app, and the balance from Logic.
Okay, so it's still, I mean, it's so you know, it's a pretty substantial operation right now. I mean, you're kind of, you know, you're in the mobile space. You're kind of in that unicorn land. You're kind of like a baby unicorn with you know, some substantial revenues. So yeah, and the valuation of the stock is actually seems pretty low comparison to the peers. You know, maybe we'll cover that in a little bit, but what's the, so, you know, in a nutshell, you're kind of like the Shopify of mobile in Southeast Asia. You got these
Correct.
revenues. You got a couple of interesting business operations, which I think I'm looked at your presentation, looked at the site. So, can you give us a little bit of insight into some of the your business operations, the markets that they're serving, and kind of what makes them unique in that in the region that you're in?
Certainly. Okay. It's been very interesting, to say the least, over the past 5.5 years since I've led the company. It is a fact that there are some very large unicorn valued companies that are privately held, Southeast Asia. There's only one that is publicly traded in the U.S. so far. That company is named SEA, or C Company Limited. They've had an extraordinary rise. They IPO'd with roughly a $3 billion valuation back in 2018. I believe it was a bulge bracket firm IPO. So if I recall correctly, it was Morgan Stanley that led it. At the time, the valuation was significant for a Southeast Asian country. However, since that time, they've grown to a $55 billion market cap. The elements of their business have some similarities to what we do. They are in e-commerce predominantly, and about 90% of that is mobile, so it's m-commerce. They do have an element of mobile gaming, which has been tremendous for them. They have an e-payment, so they're underlying Shopee Pay is their e-wallet that enables the purchase of their products on the e-commerce and m-commerce side, as well as paying for mobile games. You'll find that trait similar with other unicorn valued companies, where they've got an ecosystem of products and services, and then underlying that is an e-wallet to enable that. Here in the US, or call it North America, we've got large companies like Shopify, Wix, BigCommerce, WooCommerce. Those enable small businesses to get online. But as I described earlier, online for us in the US or developed countries is different than online in Southeast Asia. Online for us is predominantly a website that is optimized for the phone. So in Southeast Asia, you find that doesn't exist because it's all mobile. And so they need a native app. They need an app on their phone for their small business. Here in the US, it's one of those things where less is more. I mean, I don't know about you, but I've got about 30 apps on my phone, which is probably a few too many. Most people, I believe, would prefer not to have an app for every single business they frequent. If you go to Southeast Asia, you'll see people with 200, 300 apps, because that is what they use to transact and conduct business with merchants that they frequent. So, when we talk about unicorn companies there, we talk about large market cap companies here, like a Shopify or Wix. What we viewed from the onset is, okay, although back when we started, those companies were smaller, they were still substantially larger than where we were then and where we are now. I would say that where we are now is roughly where most of them were when back 5-6 years ago. So we're seeing the trajectory that they've seen. We're just a little further behind. What we've done from a strategic roadmap and from an internal mindset is more, okay, you've got these big guys out there. They're well funded by the VC community, the private equity community, the strategic investment community, and in the public markets for the Shopify's, et cetera, and then the SEA, which is here. How do we reasonably compete? And the short answer is we don't. That's not a naivety. It's more of a, okay, how can a smaller company position themselves to where we become attractive to a small universe of investors? So for us, it's, we're geared more towards retail investors. They hear the story, they say, wow, Weyland Tech is doing great things, but they're so much smaller than the Shopify's and STAs, et cetera. And then when you get in front of institutions that do have a focus on it, they ask the question. They say, how do you compete? Well, we don't. We position. So from the beginning, it was always, what can we do differently on a tactical and strategic basis that by design positions us in the future to be attractive from a strategic investor perspective or a strategic acquisition perspective. So all along the curve, that's been our thesis. So, is the eventual goal to be acquired by someone like a Shopify or a Microsoft, Alibaba, Etsy, eBay, or regionally SEA or Grab or Gojek? Absolutely. Would it be the valuation we're at now? No, because we've got a long ways to go to narrow that gap between where we are and where we should be. Where we should be, Jack, is more in line with valuations that have supported funding that in turn enable execution. So, to summarize it, I would say we've executed extraordinarily well with a modest amount. Further strategic investment interest or a strategic stake in one or more of our businesses would thereby enable us to execute at a greater scale. So I hope that answered it.
Okay. So in terms of what's the so the market opportunity, in terms of the markets you're serving, what's the size of the opportunity? Because you're in a couple of, you're operating in a couple of different areas, you have a couple of different business units. So give us a quick snapshot of that.
Sure. Okay. I would say that reasonably we would have to silo off each market opportunity because each one in itself is tremendous. And underlying those has been an upwards trajectory of moving targets. I mean, every time you look at Frost or IDG, or you look at any of the studies commissioned by Deloitte or Anderson or any of the major market research firms, you'll see that the numbers sequentially increase every year beyond their expectations. So it's hard to pinpoint precisely what that target market opportunity is, although I would say we're well below 1% as it stands. So there's a tremendous amount of room to go. Silo one, I would say, would be our core business, Create App. How do we stack up? Well, we're one of the few native app companies that is publicly traded. If you look at Shopify, again, they target websites that are desktop based, that have a mobile optimized functionality. Their market opportunity is continuing to grow as evidenced by their rise in market cap. Just even in the past few months, it's gone up significantly. The past year, the past 2 years, I mean, it's up. Similar to the companies you described that you guys work with, 1,000%, 5,000%. It's not uncommon because the underlying market opportunity is so large. So instead of looking at what is that greater picture, it's more, where can we gain traction where are we now, and how do we get to where we believe a saturation point is? We're far off from that as it relates to Create App. There's a tremendous market opportunity that we could continue down the road on. I believe in order to really get there, that's going to take two things. One is growing our market value to where we start to show up on the radar screens of the Shopifys, of the eBays, of the Alibabas from a strategic stake. And then once they do that, and there have been, and there are ongoing evaluations as we speak. So we are being evaluated by larger strategics who are looking at what we've done so far and saying, okay, so Weyland Tech has raised less than $20 million over 6 years. To them, that is a very small amount of capital investment. So they look at it and go, all right, so they've built up to a certain point. Now, if we committed an equal amount now, or double the amount, or call it 5 times the amount, what would that buy us? Could that buy us $1 billion market opportunity with what they've built and what our resources, capital, marketing, distribution, sales channel, what that could do with us behind them? Does that yield $1 billion opportunity? It absolutely does. Could we get there on our own? If we had private equity funding, or our market cap was higher than where we are and we did a larger raise, possibly. But again, from the onset, our goal has always been to attract a strategic investment or strategic stake or strategic acquisition. I hope I haven't deviated from that. I'm just trying to give context on how we view each siloed market opportunity. But that's really how we view it in terms of Create App. If we look at Southeast Asia and we look at our operations there, the e-wallet and the food delivery business, we're currently at much less than 1% of the market. Even going to 1% of the market on the e-wallet side, which could be done organically,
what's the
would
size,
probably yield
what's the dollar size of these market opportunities? Like, I want to actually, we didn't talk about the food delivery. You have the food delivery business, and you have like a last mile component, which is very valuable in Indonesia. I mean,
yes. Okay. So we do. And again, apologies for jumping around. The direct answer to the question is somewhat elusive because, again, you've got a moving greater market opportunity. And then within that, it's where is our niche. So, okay, you bring up last mile solution. Our e-wallet, let me address that first so you see how it is segued into the food delivery app. So we're tracking at about a $25 million a year gross transaction volume on the e-wallet. This year, the estimates are roughly 10 billion to 18 billion in size for e-wallets in Indonesia. And that's actually grown each year. And so there have been revisions to what that target market is. So we command very little of that. Now, could we get to 100 million in gross transaction volume? Yes, we could. That would be quadrupling where we are now. That would come as a functionality of, that would come as a function of someone taking a strategic stake in us and propelling that, or our food delivery app, which we just launched last year, which incorporates our e-wallet. So that was designed twofold. It was designed to provide a faster method of food delivery than what currently exists. So, and to enable people who do not currently use our e-wallet to then use our e-wallet to pay for said food deliveries. So speaking to ATOS Go, the food delivery business, what's different about that? And this goes back to our whole thesis on positioning. So if you look at developed markets, we've got Uber Eats, we've got Delivery Hero, we've got Postmates, we've got there's a whole gamut of companies that are in this space. Grubhub, I mean, there are DoorDash. There's dozens.
Very hot market right now. This whole
they are, yes. It's a hot market now. How do you differentiate?
And you're doing that in Southeast Asia.
True. Now, what's different about Southeast Asia to the US immediately, and the reason that Grab sold their business to, I'm sorry, Uber sold their business to Grab, which is the leader in ride sharing and food deliveries in Southeast Asia, is because here in the US, it's all by car, okay? To a lesser extent, motorcycle. In Indonesia and Southeast Asia, it's almost 100% scooter and motorcycle based. A bit of bicycle delivery, but if you look at the timing of that compared to here in the US with cars, it's almost the same. It's an average of 40 to 50 to 45 minutes to get your meal, okay, or get your delivery if it's actual hard goods. We came up with the idea to do what's called geofence. So in other words, that's a very limited location. So, so if you wanted to use our app and you were in Jakarta, you could only order from businesses that are within 1 square block, okay? However, we have gone out within each square block that we operate, which currently I believe is about 16, and the population density is actually considerably higher than New York. So there's about 33 million in Greater Jakarta. So there's a lot of people and a lot of merchants, but what it's enabled us to do is offer a foot-based delivery that actually occurs within 15 minutes instead of 45. So you would order your meal through the app, you would get it in 15 minutes because these guys are on foot. They don't have to get on their scooter, put on their helmet, go to the business, repeat, deliver it, repeat, and then go through the same process. So it's timing, it's speed to the consumer, and it's enabled us to attract the attention of the larger scooter-based giants, of which we announced last week a partnership with one whom I can't mention by name yet, but I think it's probably fairly easy to determine who they are. But nonetheless, that was our differentiation. That's scaling nicely, and it should continue to. The market opportunity there, again, it's a moving target, but I would say that currently we're far less than 1%. We've got 115,000 users. The user base in Jakarta alone is roughly about 8 million people. So, we're way down the chain. So we've got a lot of room to go. With the assistance of a strategic partner, could we get to our target of 1 million consumers by the end of the year? We could. And what I would like to point out is that valuations underlying there are similar to what we see here. So if you look at Uber Eats, you look at DoorDash, you look at Grubhub, you see valuations per user ranging from $140 per user to as much as $350 per user. If you applied that to us, just on that food delivery business alone, you've got an implied valuation of, between 14 million to as much as 40 million right now. By the end of the year, you're looking at an increase of, call it 8-fold. So opportunistically, the market itself offers a tremendous opportunity, yet so does the valuation enhancement.
Yeah. How many shares outstanding do you have right now?
We've got 12.1 million issued and outstanding.
So the market cap, today's roughly, the stock is about $5. So you got a 60 million market cap, and you have this kind of this food delivery business in Jakarta that by itself could be worth close to that. Similar to that. And then you have
definitely more by the end of the year.
Then you get the SaaS. So there's a couple of components that you have, which in terms of the comps, I think we kind of touched upon it a little bit, but in terms of the comps, if we did a direct comp with peer groups, what should the company be worth now based on the comps?
I think probably you would attribute the majority of our business to Create App, which is in itself e-commerce and m-commerce enablement on a software as a service basis. So we are most similar to the space that Shopify, Wix, BigCommerce, WooCommerce operate in. There you see valuation metrics on a multiple of revenue, which on a low end are about 12x revenues. On a high end, look at Shopify. It's what is that, like 60 or 70x revenues? So you take the lowest valuation of 12x revenues, even cutting it in half, still gets us a significant uplift. If you layer in the other sum of the parts, boy, I mean, it's a lot higher than where we are. So
I'm kind of doing the math a little bit here. So we're looking at, in theory, this could, you have a runway to 500 million plus valuation. So basically 10x from here, based on the comps.
Yes, that's fair to say. And I would say that was always our 5-year target from when we started. So we're
Brent, I want to ask you something. I was looking, before we got started, I was kind of looking at your bio. I want to ask you about, your background, the team. Now, you sold a company to SoftBank early on.
Back by backing up a bit. So I actually started in New York at Bear Stearns on the arbitrage desk a long time ago in '87 when I wasn't even 20 years old yet, but I was their youngest hire. So my first foray into finance was getting thrown into the trading room right after the '87 crash. So that was my baptism by fire, so to speak. So back then it was interesting. There weren't a lot of tech companies trading in the U.S. and there wasn't a lot of there was no electronic trading as what we know it to be now. So I was quite fascinated by that. When I left Bear Stearns, I took off for a couple of years. I traveled and I spent a lot of time in emerging markets and got an understanding of what is different there in terms of my limited knowledge, just only having lived in the US prior to that. So when I came back to the US in '97, I started in Silicon Valley. We launched a venture fund that invested in e-commerce, software as a service. We advised in and invested companies that during .com 1 were early examples of what we're seeing that are prevalent now. And so within that, when things had a reset in 2001, we spent the next 2.5 years working with portfolio companies to either right size them, sell them off, or wind them down. One of those particular companies that we had invested in and advised, we ended up selling to a division of SoftBank. So that was our first real exit in a very trying time.
Yeah, interesting. So maybe are you doing anything? I mean, is SoftBank a potential strategic investor? I mean, those guys are very aggressive.
They're interesting. They're bite size, which I would say within the sphere of big investors like SoftBank, Alibaba as a strategic, Temasek in Singapore, which is a sovereign fund. Then you look at the big VCs and big PE funds here. Their minimum bite size is significantly higher than where we've been going. So I would say that companies that they've funded are more identifiable targets of being acquirers of us or strategic investors in us, not necessarily SoftBank. We have gotten in front of them. I think their $50 million minimum may have precluded a look. Okay. But there are plenty of mid-tier investors that I think we would be very interesting to.
Okay, interesting. So in terms of, let's maybe talk a little bit about your background. We touched on a little bit, and some of the other key members of your team. You started off at Bear Stearns, where you worked with Ace Greenberg.
Yes, sir. Yes, sir. He was down the hall from us and out on the floor.
And what so you got, and then you got involved in the tech space. So like what's and a little bit more about yourself and some of the key players you're working with.
Sure, sure. Okay. So again, after selling the business to SoftBank, it turned out that the majority investor that had supported that company was based in Hong Kong. I was invited there as sort of their way of saying thank you. Back in 2003, they suggested that I move to Asia and replicate what I had been doing in Silicon Valley, because as contrast to the U.S. and having the whole dot-com reset, North Asia had not been hit as hard. So Hong Kong, mainland China, Taiwan, Japan, and Korea were really hit a little less severely, and still had a very rapid trajectory in terms of tech. So it made sense. I moved there. So North Asia was my home for a good 14 years. We did the same thing. We invested in and advised companies in software as a service, e-commerce enablement, mobile commerce, mobile apps. And then in 2014, I was presented with the opportunity to take over a publicly traded company, which at the time it had quite a different business, but I thought it would be an interesting vehicle to use to acquire something better. That something better was CreateApp, which we embarked upon in early 2015, completed September 2015. And since that time, we've grown the business. We have grown by also expansion internally and then a bit of acquisition. My team, which I give more credit to, and actually most credit to, because I think what you find in the OTC space is a lot of smaller companies, just by their very design, that have one person at the helm, who tends to make most of the decisions, gets in front of investors. We've taken a different approach. Our first year out, we looked at corporate governance. We brought on majority independent non-executives. If you look at their bios on our website, you'll see that they are very seasoned professionals that have ranged from finance, the former head of Lehman Brothers Asia, that took the first Chinese search engines public, so Sina, Sohu, and the other one, which escapes me, as well as Focus Media. He was involved with Alibaba and Tencent. And he's made Asia his home for 20 plus years. Matt Burlage. Ross O'Brien, who was formerly a telecom consultant throughout Southeast Asia. He's been operating in the region 20 plus years. Brett Lay, who was the former chief financial officer at PacNet, the former Asia Global Crossings, sold to Telstra for $1 billion back 3 years ago. There are independent board directors, and then more recently, Will Rondini, who runs Falcon out of the UK, which advises individual investors on venture-style opportunities. Will was formerly at Lehman Brothers back in the 80s and 90s. And then you look at our management team. In Indonesia, it's all locals. There's 100 professionals there from the telecom and app space, and then we've got 1,000 salespeople and couriers there. Singapore, we've got
1,000. You have 1,000 employees in.
We do. Couriers, salespeople, and actually the bulk of our team there, I'd say 970 are actually sales and couriers. So they're out there on the front lines. We're not management top heavy. As far as our management team goes here in the U.S., it's myself, John McNeil, who does have a finance background. He originally had a tech background too. He was one of the early engineers at Amdahl out of school. Then he went on to work on the buy side. He was a tech analyst and tech portfolio manager at Schroders. So he's got tech experience hands-on. He's got buy side experience for quite a large tech-based fund. And then the past 5 years since being with us, he's been involved in operations and interacting with investors on the strategic and institutional side. Then you look at Matthew Brent, our CSO. He's been at Ubisoft, which, as many people know, is a major game developer. Upper Deck, also a big licensee of brands that go into, other media, predominantly gaming, and film. Then our CTO of North America, Tom Furukawa. Tom was the CTO at Yahoo Japan, the CTO of Rubicon Project, also listed on NASDAQ. And then the team at Logic, which runs the gamut from mostly big tech companies, enterprise size, that have gone into the startup realm. So we've got a very interesting blend of people that have enterprise experience in the tech space or the finance sector, all the way to pure entrepreneurs that have worked with startups and grown them and sold them, and now are part of our organization. So we've got a very broad management breadth and depth, and certainly tenure. And then we've got a very broad reach in terms of sales, marketing, and frontlines execution as well.
I mean, your team basically. I mean, this is. I mean, the backgrounds of these people. I mean, this is very different than most micro caps. Kind of in this evaluation that we work with are 60 million, 100 million, whatever. Yeah, it's usually a couple of guys that enter, but you have like a really substantial team. I mean, this is like essentially what you find at companies that are 5 billion market cap. So you got like a pretty substantial management infrastructure, organizational infrastructure there.
We do, Jack. I think the importance of that, as far as investors are concerned, I think from a retail perspective, an individual will look at the scope of the management team and get comfort from that. They won't feel a greater sense of caution because it looks like there's one or two people. They see that there is a fully capable and well vetted and operational management team. From an institutional and strategic perspective, they look at it and go, wow, okay, so if we commit resources to you, you can certainly scale. You've scaled well on modest resources. If we put greater resources behind you, are we then going to have to scramble and fill in the blanks? Absolutely not. So we've got an infrastructure that could, as you just mentioned, support a $5 billion business without having to run out and headhunt or attract additional talent.
Okay, so you really, Weyland is like a $1 billion company dressed as a $60 million company.
I think that's correct. We hope to bridge that gap.
So let's say hopefully we'll get to some exposure in the coming months with investor audiences. We'll get the story out there, and I really believe that as the Weyland story gets widespread investor visibility, that valuation gap will close. We've seen that happen. So I mean, the fundamentals are there. So let me ask you a question. I mean, you did actually some M&A now. What is, in terms of the M&A strategy, let's say, assuming that the market cap was, the market cap increased to, let's say, 250 million, what kind of opportunities could you be looking at which could, further, enhance that value? Because we've seen that happen with a couple of our, the presenters that are, next Superstock Club.
Of course. Okay. I need to qualify that by saying that our strategy right now, as it relates to Indonesia, it would be more outbound. So instead of making acquisitions and bringing them in, we're looking to sell a stake, and we are actively in talks to sell a stake in that business to a strategic investor or financial. On our core business, we would welcome the same. On the newly acquired business, Logic, although there have been very broad discussions with potential acquirers wanting to perhaps take a stake in that business, that part would be inbound. So as you just asked, we have already been evaluating and in discussions with some even in the term sheet stage of what we call tuck-in acquisitions, predominantly on the data side. So Logic is mostly ad tech with about 25% big data analytics. Interestingly, all of our other businesses do have a data component underlying, so it's not necessarily a me too. We would look to probably acquire some smaller privately held data businesses with interesting IP. in the interim. Now, if our market cap were to grow to say $250 million, as you just asked, there are likely candidates that are privately held who we have looked to as peers, and they would be a nice fit, because I would say there's a short list of those that do not have product overlap, they do not have customer overlap, and the scenario of merging them in. And again, I think this is testament to the fact that we have an element of financial engineering and structuring in-house as well. We would look to acquire those at below market valuation so they become accretive, but more importantly, the whole thesis of, you know, the old 1 + 1 = 3. From what we've seen on the data side and what it could lend to logic is more of a 1 + 1 = 4 or 1 + 1 = 5, just given the nature of their underlying products and how they fit in with logic. So, you know, at that size, we would look to probably acquire something, you know, call it 50 to 100 million in size. Perhaps, you know, the revenues are in that range. But then if you look at the valuation uplifts, you've got companies in the data space that are IPOing right now, coming out the gates at, you know, 20 to 30x revenues, and then trading up in the aftermarket to 40 or 50x revenues. So, you know, we would have that valuation arbitrage ideally. So product fit, strategic fit, customer fit, and then the acquisition at a below market multiple, giving rise to a market multiple, I think would then in turn imply a much greater market value, as opposed to trying to buy revenue and then, you know, add on in on that sense. So I hope that answered the question.
Brent, what, you know, assuming everything goes right, what is, you know, what's your vision for, you know, what is Weyland going to look like, you know, 2-3 years out in an ideal scenario?
Okay, so, you know, if we haven't been acquired by, you know, by a much larger peer company, I would say that you would see 2 years out probably an exit from the Indonesia business at a great valuation. On the Create app business, you know, tracking as we are, you would probably see something similar. And underlying, you would see Logic as the core business, albeit, you know, under the parameters that I just laid out, with additional ancillary and complementary businesses that then give it a much greater scope. Big data is here to stay. Big data valuations will further drive, you know, innovation, further penetration into target markets that, you know, currently are just now starting to embrace big data. So what you're seeing as it stands right now, even though there have been massive uplifts in valuation and market caps, that's enabled, and as you've seen with your companies on Wall Street Reporter, being able to raise funding, being able to have a higher market cap, what you do with that can then position you to do even greater things. So, you know, with Logic underlying, you know, we would hope to grow that business because that underlying market opportunity is significantly greater in 2 years, 5 years than where it is today. So, you know, getting there is only part of the battle is getting the market cap. You know, I think the real win comes in using that market cap to grow into a much greater realm.
Okay, but are you? I mean, what do you do? Are you building a $500 million business? What's your goal in terms of, let's call it, I don't know. Let's just say, I guess we could talk about revenues, but really, maybe I guess the bottom line really is the valuation. I mean, what is your goal in terms of valuation for the business? What kind of shareholder value? You know, because your team, it's obviously guys who, you know, their background is, you know, in M&A and in you know, arbitrage.
Mm-hmm.
You know, it's all about, you know, maximizing shareholder value.
Right.
What's the goal?
Okay. I think the answer within is really twofold. I mean, there's my personal opinion, which I'm probably not. It's probably not fair to say. I would look at it as.
Tell us your personal opinion, Brent. Give us your personal opinion first.
Okay, 100% personal. I think we should currently, based on where we are, based on the sum of the parts, based on the opportunity, based on the team, we should be at around a $240 to $250 million market cap right now. And I just base that purely upon companies that are similar in size, who incidentally have a call it a lesser product and service line, and with all due respect, less of a management team capability. If you look at us in terms of taking my personal opinion out of it, where should we go? I think the easiest answer to that is look at the peer companies that are in, just call it software as a service, e-commerce and m-commerce enablement. So Shopify's, Wix, BigCommerce has just filed to IPO this year. Those valuations, again, those are well in excess of 12x revenues. So could you apply that to our current track this year of about 50 million in revenues? Sure. And what does that yield? As they say here in the Northeast, you do the math, right? If you look at data, you look at logic, and what are those valuations? Again, 20 plus x revenues. Logic this year, we have come out and publicly stated they're on track to doing 18 million in revenues this year. So you apply that multiple to them, that far eclipses our market cap, and probably just that alone puts us up into the sphere of my personal opinion on where the whole company should be valued. And then if you look at Indonesia, you say, all right, if you sold a stake in the company, what would that be worth? Significantly higher than where we are. So some of the parts valuation, significantly higher. My personal opinion, significantly higher. Doing one's own homework and going through our PowerPoint, which is purely publicly available comps, privately held funding valuations, and M&A, you do a little bit of research and you say, okay, this is Weyland Tech now. These are the valuations that exist in each of their segments, and this is a generalized valuation. Could they trade at a much higher value, and is that much higher value $240, $250 million? And is it overvalued there? Yes, and to the first, and no to the overvalued. But I don't want to get in trouble. But again, I feel that we're significantly undervalued.
Okay. The stock is trading on the OTC right now. There's not a lot of liquidity. I mean, the stock basically runs we're seeing a run $1 up $1 on 20,000 shares. What do you have plans? Because basically you qualify now for NASDAQ at this point.
We do meet the quantitative requirements. We have stated publicly that we intend to uplist to a senior exchange. We have done a number of things internally to qualify for a senior exchange. There's two things that we view. There are well in excess of several hundred companies per year that try to make it to the uplist. So what we don't want to do is attempt to make an uplist and fall on deaf ears, just trade flat. That's not what NASDAQ or NYSE is interested in, and that's not what we're interested in. So underlying all of that, it's not just trying to achieve those criteria. It's what does the business look like? And when you finally get in front of an ongoing stream of institutional investors, and the questions are, what is it that compels us to pay a higher value than where you are now? What's your business look like underlying? Are you going to stay a 50 million or $100 million company? Or once you get into the realm of a $250 million or $500 million valuation, what's underlying to support that? Because they're looking for companies that they can come in sequentially to as those companies execute and hit milestones, whether it be revenue, earnings, market share, or acquisitions. So underlying all of this, before we make that big push to fully uplist, we want to have the pieces in place. And maybe part of that has to do with market cap. I think it's a lot more interesting to uplist with a higher market cap than lower, because then it opens up the universe of institutional investors that can actually take a look.
Okay. Now speaking of sequential, what are some of the key milestones that you have coming up, like over the next let's just say 6 months? Like, what kind of news flow can investors expect to see?
Okay. I will preface this with public statements we've made in the past. It is a fact, and it is publicly stated that we are in talks with, and we believe these talks will both increase in frequency, as well as broaden, as well as see more normalized valuations in terms of our Indonesia business. We believe we will be in a position to announce something along the lines of either a strategic initiative, a strategic sale of a stake in the company. That would benchmark our underlying thesis of maximizing shareholder value through actually doing stuff. It's feasible that Create App could do something similar. As it relates to Logic, what I think you'll see on the public side goes back to our strategic roadmap. As I just described, tuck-in acquisitions, more of a transition from ad tech big data to more big data. Underlying everything we do is big data. So not to deviate from your question, but we are in three very, very relevant and call them hot markets right now. We're in e-commerce enablement. We are in Southeast Asian fintech, and we are in big data with Logic. Any of those on their own are extraordinarily exciting for public companies. We've been in them, from the onset, and so I believe that what you'll see in terms of announcements will mirror what we've already been talking about. But what you'll see that's different is that there is, actual, execution of those initiatives.
Okay. Brent, last question, which we always ask all the CEOs is, in your personal opinion, what are the top 3 reasons why investors should consider the Weyland stock today?
Sure. I'll say that one of the main reasons is something I was highlighting earlier. Take a look at the management team. Take a look at the product line. Take a look at customers in terms of Logic. The customers that Logic serves here in the U.S. are publicly traded. They are enterprises. They are big e-commerce companies that use our services. So credibility, validation. Look at the backgrounds of our management team. What's different about us than a lot of other smaller companies? Can we adequately scale? Yes. So check the boxes on due diligence. And whether you're an individual or you're a portfolio manager of a major fund that invests in microcaps, you'll see that we check most all the boxes. So that would be one. Secondly, look at the market opportunity in any one of the sectors we're in, and these are all on our presentations. But what potential do we have as a company, and what potential do we have in each of our 3 business units? And can we continue to grow that, and quite probably at a greater ramp? And does that warrant a higher valuation? And then thirdly, valuation. Okay, where are we now, and where are those comps? You can carve it up into the valuation metrics on our presentation, or you can do your own homework and say, okay, what do similar companies trade at, and what would that imply for Wayland? You can even cut that in half, or take a fraction of that, and you'll still see valuations come out the other end significantly higher than where we are.
Okay, so I guess the bottom line is investors should do the math, and you don't even need to use a HP12C. This is a basic.
And I do know what those are because I had one in my shirt pocket back in the Bear Stearns days.
Perfect. Brent, I want to thank you for your time, and we look forward to getting the full presentation next week for the next Superstock live stream. That's going to be July 22nd. And everybody can click the link below, sign up, and we'll have questions for you then. Brent, thank you, and we'll see you next week.
Great. Jack, thank you so much. Take care.